Ahoy there, traders. How are you doing? I've spoken about this a few times this week in various places. I don't normally compare what we do to gambling. What we do is not gambling. Although we can take some of the principles and draw straight line comparisons, but from the perspective of being the casino as opposed to the gambler. So we want to flip the narrative on what most people would typically talk about. So we're going to basically just dance around the subject of what casinos know and why they work, and what makes the principles that they use, that they have in their everyday business, and how they transfer over to what we're trying to do. And where most people go wrong is they're the gambler in the casino as opposed to being the casino. So we want to be the casino, and that's what we can ultimately do. So now that everyone's here who's going to be here, if you are new to these sessions, we're going to spend about 60 minutes talking about the charts, the markets. I generally don't comment on the news. It's of no consequence to the way that I approach things, but it is unavoidable to acknowledge what is going on at the moment. Despite that, the way that I approach the market, I'm not usually looking at current affairs locally or globally, because it doesn't impact the way that I trade. So again, just acknowledging it, I'm just not going to go there. Going to spend 2 minutes just introducing myself for those that are new, or maybe you're watching this for the first time on the replay of the recordings, and then we'll get into the charts after we've just discussed my story. So we're going to look at the casinos. It'll only take 2 or 3 minutes to explain it, but it's an interesting concept nonetheless. The way that you get involved, the way to get most value out of it is get involved. The chat box is on my other monitor, so if you've got questions, comments, observations, if you want to ask something, feel free to. I think we've found a subject that I won't talk about. So if you've got questions about that, I probably won't answer them. Anyway, if you've got a question, pop it in the chat box, and when or if it's relevant, I'll address it in the moment. So if you are new to these sessions, as I say every week, oh, my thing's just decided to crash on me. Here we go. I'm just a regular guy. I say this every week. It's true. I've not worked in Wall Street. I'm not a Wall Street guru. I'm just a regular guy who likes to enjoy himself. I like cake, coffee, books. I like spending time in coffee shops, going for rambles. That's what, in fact, I've done this morning. I met up with some friends that I've not seen for a while. Coffee, cake, have a chat, put the world to rights, and then go and enjoy myself. And today I'm doing this open session. I'm very fortunate to be where I am. It wasn't always that way. Like most people, we worked hard to get where we are. But my lifestyle is as a direct result of the market. So I'm very, very grateful. I like to acknowledge that. And in these sessions every week, I try to show you what I do in some small way and just give back to the community, because I didn't have anyone to ask when I first started out. Despite that, I am not a financial guru. I tried to say dude and guru at the same time. It came out good. I'm not a Wall Street guy. I've never worked in the city. I'm just that guy who's figured a few things out. It's also worth noting that the financial disclaimer is I'm not a financial advisor. You can take what I say with a pinch of salt for all I care. Again, I'm just trying to give back to the community. I'm trying to show you how I make it work, and just understand that it may be a little bit different if you try and apply it again legally. My results are no guarantee of your results, etc., etc. We're all adults here. I've got to say it. But what we can show you, what I can demonstrate, is the benefits of my experience and the things that I've seen and done, so that you don't have to go through the 20-year learning curve that most people go through before they either, one, give up, or two, start to see some sort of success. You know, you can speed up these things. The way that I approach the markets is called, or I refer to it as a production line process. It's by intention, because I want it for myself first and foremost. I want a production line for my own. Again, it allows me the lifestyle that I lead. You know, I want to be able to find opportunities, place those opportunities, manage my existing trades, and then go and do something else. Something else today being this open session, and then later on I've got my usual honey-do list. So I'll be doing a few chores. It is replicatable. I like to say it's replicatable. It's not just me saying it's replicatable, it's other people. You know, we've got a lot of success stories over the years. I've been coaching and helping people along the path for uh, 20 years now, almost exactly 20 years. Yeah. So a lot of people have found their successes. Hello, Randall. Thank you for the new kind words. But people tell me they're getting results. So it's not just me saying that it is repeatable, replicatable, and that it works. It's you guys that put the hard work and the efforts and the energies in. Of course, I get my own results, but nonetheless, they can be repeated. I'm going to show you how to repeat it and replicate it in just a moment. That's why we're all here. Phil, show me the charts. But nonetheless, I'm just trying to demonstrate that it works. What we don't want to do is be like a zombie. My favorite slide is this one. We don't want to be flicking through chart after chart. I was certainly a chart zombie in the past. We've all been at some points in our lives, but it's just not necessary. We do not want to be flicking through chart after chart like a mindless zombie, trying to find the the stock market equivalent of Where's Wally. That's essentially what we're trying to avoid here. We want to, and we should be able to just zero in on the right opportunity at the right moment, and that's what I figured out. So that's exactly what we're going to do. Where's my slides? So let's take a look at the casinos and what they know, and let's try and figure out why some people don't do it. So casinos know this. So what do they know, Phil? Glad you asked me that. So they know that the market, or they know that over a series of events, it doesn't matter whether it's roulette, it doesn't matter whether it's cards, slots, bingo, whatever the game is, the game of chance. The way that most games are designed is they have some inherent edge in them, but it's not as the player that the edge has, although you can have winning streaks and losing streaks at, say, at roulette. What the casinos know is that over a series of events that the house has the edge. So they make their money over a long period of time by playing every hand in the game, or every roll of the dice, or every turn of the wheel. You get this. It's a very simple concept, but it's something that most people don't consider in trading. Now, the elements that we want to take away from this is consistency. In trading, we need the fancy way of saying it is a positive expectancy strategy. And that's a fancy way of saying it. Does it make money? Yes. Does it make money? Yes. Does the way that you want to trade make money? And sometimes the hard parts about trading, especially for newer traders, is that there's lots and lots of things, lots of ways of trading that work. Now, the tools don't matter. It doesn't matter whether it's Dow 3, GAN 3, Elliott Wave Theory. It doesn't matter whether it's MACD, CCI, RSI, 10CC, CC Peniston, Return of the Mac, whatever the tool is, it doesn't matter. It absolutely does not matter. It's a tool. It's a tool to be used. It's not a methodology or a process. So that's what I just want to draw a distinction against. I've used most tools throughout my trading career, and it doesn't actually matter. Again, one of the ways that I actually was trying to apply trading consistency in my own trading was to try and keep consistent with the strategy I was using at the moment, is to keep my idle fingers busy. Because what I did know, or one of the habits that I was trying to break, like most new traders, we have some bad habits, usually driven by our emotions, our emotional reactions. And I had this tendency to tinker with trades, as I refer to it. I would move stop losses, I would move targets, from 1 minute to the next. There was predominantly day trading back then. And I spent 12 years doing it. So it's not that day trading doesn't work. It's just that our ability as traders, our human elements, interferes with the process that we're trying to follow. So I used to think with trades, I would move the stop loss. Oh, it's moved up 5 points. So yeah, right. Let's move the stop loss, and you put it to break even. Then you get stopped out for a break even trade, and then you wave bye bye to the trade as it does what you thought it was going to do and smashes through targets. We've all done it. We've all sat on the sideline watching the trade that we were in 5 minutes ago sail off into the horizon without you. We've all done it. Inevitably we're breaking the process or breaking the rules of the system. So we want to apply some consistency. And this is why we have rules. So I've completely lost my train of thought there for a moment, but nonetheless, that's what we're trying to do. The consistency element, and it's to be able, there we go. So it's to get the, a similar outcome to the strategy, the process. Again, whether it's day trading, swing trading, whether it's investing, whatever it is, we want the consistency over a series of events. There we go there. Should have gone back to that slide. And again, trading's the same. We want to be able to emulate the process. So let's just go to the charts, actually. Let's just try and illustrate this point. One of the things that I'm been able to do recently is to codify the way that I trade. Now, what this means is that I can take the way that I want to trade, which is swing trading. I usually refer to it as get paid at the end of the month type of swing trading. It's got that payout cycle, and you can turn that dial. So if you want to speed up the process so that it goes a little bit faster, you can take the same strategy and have a payout cycle at the end of the week. So this is one of those customizations that we can do, and we should have that built into the process. So anyway, I like to get paid at the end of the month. It allows me the time freedom to take days off. I only need to check the markets at the moment 2 or 3 times a week, and that's by design, that's intentional. But if you want to speed things up, I know 1 or 2 of you have turned that dial so that you're getting paid, somewhere between 1 and 3 days. And that's fine, you can do that, but you've got to validate the process. And I think one of the reasons why it's used the metaphor that we've been using as a casino, instead of being the casino. So this bit is the casino, as if we're the casino, playing every event over a series of events so that you get consistency. Now, what I'm trying to do is emulate this and try and be the casino. That's what we do as traders. Again, because this is no guarantee of future performance, but this is what a positive expectancy strategy looks like. So I'm trying to emulate this. And this is, again, why we have rules. So where people deviate from being the casino in this and having a winning streak over a series of events is that they're trying to cherry pick opportunities, and they may bounce around from chart to chart, as my usual example. They're going, is the opportunity here? Is it there? Is it here? Is it there? And they'll jump around, because it's not that a strategy or the strategy doesn't work. It's just that they're not applying it with consistency. They're jumping from one chart to the next, one opportunity to the other. So the way that I combat that is to have a universe of stocks. So my universe of stocks is reasonably small. Again, I'm going to focus on, they look small, but there's 89 stocks at the moment in my universe. It's actually a bit more, just because I'm doing some sector plays, which we've spoken about previously. But just over here on the left, the top 15 stocks. So I'm wanting to apply this strategy on a small group, a small universe of opportunities. So I'm not trying to trade every known stock in the universe. I'm not trying to have a 2,000 stock watch list or a 27,000 stock watch list. It's impossible. And that's the mistake. That's the trap that we fall into, because, well, certainly new traders will fall into, because there's thousands of stocks to trade, but not every stock is worth trading. So what we want to do is we want to match the strategy, which we've got, the way that we want to trade, which is swing trading. That's why we're all here. We want to be able to do other things around trading, whether it's the day job, whether it's family life, or if you're like me, you want to have lots of free time and go and enjoy yourself. That's what we want to be able to do. We don't want to be glued to the screen. But at the same time, we don't want to miss opportunities. So we end up sitting here looking at every stock every day, all of the time. So wouldn't it be easier to find a group of stocks that behaves in a way that is favorable for your preferred style of trading, in this case, swing trading, so that we can have a very narrow focus, so that we can emulate this performance on, again, this is the S&P, but we can also emulate it on a stock like Apple. Let's take a look at Apple. So why is Apple in my universe? It's because it has, firstly, a positive expectancy. It's got a nice steady equity curve. And it's not just that I'm interested in. Again, past performance is no guarantee of future performance, but this is dancing to the same tune that I want to play, my tune being swing trading, if you get the metaphor. So I know that this is a favorable stock. It behaves in a way that is ideal for my style of trading. So I'm going to include this in my watch list. Now, to give you an example of what I'm not looking for, let's take a look at Pepsi. PEP is the ticker. Again, it's not that, let's click the charts, PEP. It's not that Pepsi is a bad company. We know it's a good company. I intentionally use it for illustration. And if I've been visually, if I traded it the way that I like to trade in the last 12 months, it would have worked fine. It would have worked fine. But that is not, and that's the, I suppose, while we're talking about casinos and gambling and all that, that's the gambler's fallacy. Oh, it worked in the last 6 months. You've had a winning streak in the last few trades. Therefore, it must be a good company to trade for your style of trading. I'll take the next one, please. And the reality is that it's not a stock, as we can see here, because I can plug the rules into a bit of software and say over the last 20 years, what would have happened? Is it favorable for my style of trading? No, because there's the zero line. Again, it's not that Pepsi is a bad company. It was behaving favorably for 6 months. But the reality is it's long-term, not a stock that behaves in a way that I will find beneficial. Now, if we put this into this comparison, again, I appreciate we're using the casino metaphor. So if I try and trade every event, I'm going to emulate this performance on this stock. So this isn't a great candidate. Again, it's not that it's a bad company. It's just that it's not a favorable company for my style of trading. Pregnant pause, let that sink in. Does that make sense? So it's not that, again, just going back to one of the early points, it's not that trading doesn't work. It's not that a strategy doesn't work. It's not that your broker's out to get you. It's that a series of unfavorable events are causing you to have an unfavorable performance. And maybe your trading style, again, swing trades, that's why we're here. Maybe your style of trading, presuming it's swing trading, because that's what I talk about every week, is not favorable on the group of stocks that you're wanting to trade. So you're emulating the exact performance for the stock. And if that stock or that instrument, again, it could be futures, it could be Forex, it could be, and this works, to be fair, this works on Ethereum really well. But let's just go back to the S&P. We're all trading US markets. So again, I want to emulate that performance. So why am I doing this? I'm doing this I'm swing trading on this instrument to try and emulate this performance because I know that it has a positive expectancy. So if I should be able to, over a long period of time, and trade a large number of events, see a similar performance. This is positive expectancy. This is what we're trying to do as traders. And I think that most people miss out some steps. They've got a strategy that works, for example, but do you know it works? I mean, I've got to admit, for, where are we? 25 of the last 28 years that I've been trading, I didn't know if what I did worked. That sounds pretty fucking crazy. But it's true. It was only... Now, my result, my performance, the money that I was making was good. I knew it was working, but I didn't know if it was me, something that I brought to the table, some secret ingredients that only I knew. Again, I'm not even going to pretend to say that I'm academically smarter than anyone else, because I know many smart people, but if you've not got the ability to follow a list of rules, then you've just not got the ability to follow a set of rules. So I was trying to figure out, is it me or is it the strategy? And what I've been able to do is to absolutely and categorically quantify that the strategy has an edge. And not only does a strategy have the edge, the swing trading strategy that we use, but it also has a quantifiable edge, because this is what it looks like. And what I was able to discover is that something that I knew, I've said it for years, is not all stocks are worth trading. And the example that I usually give, like, for example, I don't want to trade illiquid stocks that have volume, average volume traded of less than around 1 million shares a day, because it's got lower liquidity. There's lower trading. It's not that they're bad stocks. It's just that it's got lower trading volume. And my experience with those types of stocks is that it's inconsistent performance. So I cut them out of my universe, and I learned that the hard way. Penny stocks, again, I don't want to trade penny stocks. It's not that they're bad companies, but they're penny stocks for a reason, is one argument, but that's an opinionated viewpoint. Again, my own personal experience with trading penny stocks is not favorable, whether it's been day trading, short-term swing trading, or kind of like that somewhere in the middle, medium-term swing trading, between 1 and 3 months. That's kind of like where I trade at the moment. But I've traded a multitude of ways over the years, but I've never found consistent success with penny stocks. So then you start to ask the question, is it me that brings it to the table, or is it the strategy? And what we've been able to discover is that, well, the strategy works, but not on everything, because I already knew that not everything was worth trading, and certainly not everything was worth trading all of the time. But by matching those two things together, a proven strategy on a group of stocks that behaves in a way that is favorable for the style of trading that I'm looking for. And this gives me a universe of stocks. And again, we've got, again, 89. Again, I'm going through them again. Again, every time I get a strategy update, an algorithm update, I'm refining it and ironing the code out. Again, it's not that the strategy doesn't work, but we're able to, quantify and qualify everything that we're doing. So this means that it's not something that's unique to me, the unique to what I bring to the table. Because as we said last week, I can explain the list of rules to you. I'm going to in just a moment. If you just follow them, you should be able to replicate and emulate something similar. Again, I'm not going to promise that everyone's going to be exactly the same as the algorithm, exactly the same results, because you may take a trade on. I mean, for example, I just missed a trade yesterday. Again, it's human nature. WMD is a trade, is stock that I was wanting to trade, and I missed my entry. Human nature. So I'm not going to be able to get everything just because I delayed placing my trade. So again, it's human nature that we're going to see a similar performance. And maybe I didn't take it at the right place. I was going to take it a day later. I decided to wait a day and now feel like I'm chasing the trade. So I'm not going to get every opportunity, but I should be able to emulate something similar, a similar performance. And that's what we're trying to do as traders. So if we match the strategy with a group of stocks that is favorable, we should get something that is exceptional. And the idea is, by doing that, is that I don't have to second guess, is this the right trade for me? Is this the right stock? Because these are all questions that we ask ourselves because we've not been able to validate our trade idea or the strategy. Because like most of you, one of the most common questions that I get is, am I doing the right thing? Am I doing the right thing on the right stock? Am I doing the right thing on the right stock at the right moments? Well, we can answer all of those questions. So let's do it. Let's show you how to get in the right stock at the right moments. Firstly, you need a list of stocks that is worth trading. If you want a copy of mine, you can have it with my love and blessing. There you go. There's 15 stocks that are great. These are great candidates. They are favorable for the way that we like to trade. If you want to do your own research, there's plenty of tools available to do this. You don't need TradeStation if you don't want it, although that's my tool of choice. But you can plug in these if this, then that rules into some of the online software. TradingView, for example, has that ability. You can do if this, then that, and you can quantify all of these rules. So let's go and look at the rules. So in fact, let me just tidy the chart up a little bit. Bear with me a second. So what are the rules, Phil? Stop teasing us. What are the rules? What are the rules? So works in up and down markets, works in any markets. So the rules are the 200-period moving average is there on the charts, the 50-period moving average and the 20-period moving average is there. So we've got 3 lines on the chart. The lines aren't important. The calculation is not important. If you want to use a simple, exponential, triangulated, weighted, backwardated, forwardated, whatever ated that you want to use, just use it. It doesn't matter. It's already said, that was one of the first things that we said earlier. The tool doesn't matter. The tool is a frame of reference. It's a focal point. If we were talking 5 years ago, we would have been doing exactly the same thing through the lens of the Bollinger Band. It doesn't matter. It really doesn't matter. That's the one thing that I have proven to myself. All we're trying to do is find good candidates that behave in a way that is favorable for swing trading on a group of stocks that is favorable to that style of trading, that swing. We need price movements to be able to profit from it. So that's what we're looking for. So I'm looking for the 200, the 50, and the 20 to be stacked on top of each other. 200, 50, and 20. So they're the three things. So when they're all stacked on top of each other, that happened here. So back in July 2020, that's when that happened. And this was July. So at that point, we can be bullish. Cool. Groovy. However you want to phrase it. So at that point, we can say, okay, well, on this chart, again, whatever stock that you're looking at, this is the S&P, whatever stock that you're looking at, could be the S&P, it could be Apple, it could be Halliburton, it could be energy, it could be an ETF. Does it work on ETFs? Yes, it does. It works on most instruments, but you can get the strategy, match it up with a group of stocks that historically behaves well. So that's what's in my universe. It's not that the strategy doesn't work. It's just that maybe the instrument doesn't behave favorably. So this is what we're trying to do. So we get these rules. Anyway, 250, 20 period moving average. So at that point, I can say, you know what? At that point, I'm only going to be looking for bullish trades. So the next thing we want to do is we want to be doing a BTFD, buy the Samuel L. Jackson dip. Buy the dip. That's what we're going to do. So this is what it helps us with the direction. So we want to buy the dip. And the bit that they don't tell you when people say that phrase is in an uptrend. Just adding that phrase to your trading routine is going to make things a lot easier. Because just because prices, like over here, just because price is selling off, and that was the crash, just because price is selling off doesn't mean that it's a dip in the context of a trend, because we need a trend to be able to buy the dip, just like we need a rally in a downtrend to sell the rally in a downtrend. Now, if we had identified that price was in a consolidation, a range, we're going to do something different. We're going to buy range lows, sell range highs. We're going to buy the break of range highs and sell the break of range lows. But in this case, it's a trend. So we want to buy the dip. There's only 6 things that we can do. There's actually 8. We can counter trend trade. I just prefer not to do it. It's personal preference. There's no reason not to do it. I know, Kevin, are you here, my friend? Yes, I think you are. And Kevin likes to counter trend trade. He's found great success with it. I just don't like doing it. It's personal preference, and that's cool. Anyway, we've identified a trend, a mechanical routine. And because it's mechanical, I can plug that if this, then that rules that I mentioned into software. And I can quantify and back test the idea. So then the next part of it is, okay, well, I want to buy the dip in a trend. We know what a trend looks like. Averages are stacked up. Prices above the averages is the next part. So price needs to be above those averages. So what I'm looking for, and if I just get my, there we go. So if I just get, so what I'm looking for, what you can see on the chart is when price is above all 3 moving averages, then I'm going to call that a phase 3 trend. Phase 3. It's not in any textbook, it's just what I call it. Phase 3 trend. When it's below the moving averages, let's get the other color. When it's below the moving averages, I want to close my trades. Or it's between the moving averages. There we go. So there's a there. Okay, so when it's above the moving averages, I want to be bullish. When it's below the moving average or between the moving averages, I want to be in cash. But at the same time, that is also what I will call a buyable dip. So if I'm not in a trade, this is what I'm going to look for to place a new trade. Is everyone happy with that? Simple rules. Above the averages, go long. Between the moving averages, go to cash. And at the same time, we can use that same go to cash rule as qualifying a buyable dip. Fabulous. Several yes in the chat box. Are you happy with the rules? We said this last week, I can sit down with you for 20 minutes and explain the rules of the strategy. Like learning golf. You can learn golf in 20 minutes. Here's the rules to golf. Great. You're now an expert at golf. Are you really? It's going to take a little bit of time, a little bit of practice. And as I showed you earlier, sometimes I'm just not at the computer to place the trade. I'm a human. I will make a few errors in judgments, but it doesn't mean that the strategy doesn't work. So now you've got the strategy. You've got it. Above the moving averages, go long, you'll make some money. Below it, go to cash. And maybe it goes above and back below. You're going to lose some money from time to time. Again, it's not 100% strategy. There's no such thing. So what we do know, bringing it back seamlessly, what we do know is that over a series of events, I couldn't remember what came after 5 then. Did you see me? Did you see my cursor just falter for a moment? What comes after 5? Oh dear. Laughing at my own stupidity. I was trying to talk and write at the same time. And what I was talking, it was not the same as what I was going to write. And I found it very difficult very briefly. Oh dear. It's Friday. Let me off. Over a series of events, like I'm just added them up there. You know, it might be, I might have missed 1 or 2, but you get what I'm trying to illustrate it. Over a series of events, just like the casinos, just like that seamless callback, just like the casinos. Oh, help me out here. Just like the casinos. We want to be the casino because they know they have an edge over a series of events. They don't know which events are going to be the ones that make them money. So they play all the events with impunity, with consistency, because they know that over a series of time, they will make money. And we know this as traders. So what makes me any better than anyone else? Well, you've got the strategy. You're no different from me. But the thing that I know, and the thing that I keep trying to teach everyone every week and show you on these Friday open sessions, and I show all my students in the private sessions how to do this faster, go faster, make more profits, make more consistency, because there are some nuances to it. Like learning golf. I like the metaphor. We came up with this last week. Like learning golf. I am having one of those days, Steve. Yeah, the coffee's just kicked in. I had too much coffee this morning. That's what it was. It has literally just kicked in. You've really pushed me off course there with that question, Steve. So there we go. Golf. Yeah, absolutely, Randall. It's thanks for bringing me back on point there. I needed the assist there. So golf, you can learn the rules. Like trade, you can learn the rules in an afternoon, assuming that there's rules to learn, because some people don't have any rules, and that sometimes makes it difficult. I know some great traders who they know the rules, but they've not quantified. They're discretionary traders. They're using everything that they know up to this point in time to make trading decisions. That's discretionary. There may be some loose structure, but that doesn't help you as a new trader who wants to learn from that person, because they can't replicate the results. It's not that the strategy doesn't work. It's just that it's heavily discretionary. This is why I don't trade patterns anymore. I used to do pattern analysis. I used to be very good at pattern analysis, but it's subjective and it's not replicatable. And the textbooks would have you believe that if you just look for this triangle pattern, blah, 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 you're going to make gobs of money. It doesn't work like that. Unfortunately, it doesn't work like that. I wish that it did. But this is a quantifiable mathematical algorithm. When price has done this, do that. When price does this, go to cash. But this is what a Bible dip looks like. Get the trend, 3 rules. Average prices are stacked up, 1, 2, 3. And we've got one rule for a dip. When it's below or in between the moving averages, that's a buyable dip. Great. I can take those rules. We've already seen the thing. I can take those rules and pop it into the algorithm. And it says over the last 20 years, over multiple events, this has a positive expectancy. Great. I want to emulate that. No guarantee that I will, but what I should be able to do, if I do nothing else but follow the rules without any discretion, I should see something similar. That's the best that I can offer. I'm not gonna lie to you. I've got no vested interest in this. But if I just did that, I should be able to emulate this. Great. That gives me confidence. That means that I can sleep at night. That means that I can go away and take a few days off here and there. I can go traveling, hiking. I went to a townhouse yesterday. I can be up a mountain next week. I'm going to do things. that don't require my attention to be at the computer, flicking through chart after chart, wondering if the next one is the one, using an indicator, MACD, GAN theory, Dow theory, Elliott wave theory. Maybe I'll try RSI this week. Wonder if I tweak the settings. What if I use a 100-period setting instead of a 50-period? It doesn't fucking matter. Just pick a tool and be consistent, because over a series of events, you will make money. While we're at it, while I'm indicator bashing, there's no such thing as overbought or oversold either. It doesn't fucking exist. Get over it. Oh, I'm allowed it. I'm allowed it. The copy's kicked in. So if I don't know what's going to happen next any more than anyone else, but what I do know is that if we follow a system, any system, this system, I would hope that you do, because I've put a lot, I'm 28 years into this. This is the culmination of 28 years of knowledge. It's taken me that long to realize that there's so much that I didn't need to do. I didn't need to do the pattern analysis. I didn't need to do all of that. But if you can just follow one system, one rule, use one indicator, promise I won't go all Freddie Mercury with you and start talking about fried chicken. Buy the dip in an uptrend. Sell the rally in a downtrend. You've got to ask the question, what am I going to call? What am I going to quantify as a trend? Great. Now that you know what those rules are, that is the definition of a trend. Not it looks like, not it's maybe kind of coulda, woulda, shoulda. This is a de facto statement of what you consider, or in this case, what I consider to be the trend. That is a statement. And when you know that rule, no one's in disagreement. There's no subjectivity involved. Now that you know what the trend is, you can apply dip buying criteria. When price, again, let's just use the 50-period moving average because it's right there. 50-period moving average. Every time price comes to the 50-period moving average, that is a buyable dip. Great. I'm interested at these points. That means that everything else that is not doing that, or a day that that isn't happening, I can be up a mountain. I can be hiking. I can be doing something else. I can be here telling you these rules. I get to be doing something else. So right now on this chart, this is the S&P. S&P is not in a buyable dip. It's saying you should be in cash. Cool. Now, although this is the markets, the S&P futures, it doesn't mean that there's not other opportunities elsewhere. I can go and look at other stocks, other opportunities. Okay, great. Now you know that. Everyone happy with the rules? Before I just move on very quickly. And my drawing widget's just crashed again. Everyone happy with the rules? When that their chart is going up, buy the dip. What's the dip? What's the trend? Now you know that. Cool, great. So what I was going to do, I was still on for time to ask the question. I was waiting for the thing to reload. So that's what this is. So these red, blue, you've seen me use these before. Red, blue. I can look down lots of instruments. So 89. So my universe of stocks is 89. You don't have to choose 89. You're going to start off with 15. Maybe it's 20. Maybe it's 30. Maybe it's 300. You know, if we were doing this a couple of years ago, I was trading 300 stocks. I'm happy doing that. My tolerance for risk is very, very high. I can have a lot of market exposure. I'm okay with it. But maybe you're not there. So the first part of this, you've got the strategy. The second part of it is to use a list of stocks that is favorable for the style of trading. Here's my top 15 on the left there. If you take a screenshot, have it. You can go to my website. You can download it for free. Done all the work for you. But if you are looking at this list of stocks, I still don't want to look at 15 stocks every day. As you might appreciate, it wouldn't take that long to do it. But I don't even want to do that. I want to look at the right stocks at the right moment at the right time. So I've got this little cool traffic light system going on at the moment. And that's all this is showing me. It's saying, okay, these stocks, LNG, SQM, PXD, these stocks are above the 20 period, above the 50 period, above the 200 period, and the bullish trend that I mentioned is going on. So I can say I should be in a trade on these stocks. Let's take a look at LNG. Those of you who know me and follow me for a while, we've spoken about the energy sector for a long time. I've had multiple trades on this last year and this year. So LNG, I'm only showing you the chart so you can see what we're doing here, but it's above the two. That's what this. It's above the 200. It's above the 50. It's above the 20. It's 300 days in trend. It's a long-term trend. The trend is bullish. Great. So those stocks there, that's what it's shown me. So as of yesterday, these are in a bullish trending state. They're above the averages. Go long. Great. Now I'm already in a trade. I've taken a brand new trade on PXD. Took that on Tuesday. Why? Well, the previous trade, that Bible dip that we just mentioned, was right there. My targets, predetermined, predefined, was right there. I decided to close it just before the war. Just before the war. Didn't know it at the time. I just thought, okay, we're almost there. In fact, it was before the long weekend. It was 80%. I think it would be fair to say we're almost there. 80 to 90% of the way there. Going into a long weekend. I just thought, I'll have that. Thank you very much. That then creates the Bible dip that we just mentioned. It comes back to the moving averages. There's your next Bible dip. You know the rules. You know the rules, you know the stocks. So that's what I'm looking at there. So if I'm not in a trade, I can look for a trade. Now, Halliburton, I don't know if you see that. We've got these stocks here. This is the dip, red. So blue trend. So we've got a bullish uptrend. Price is above the 200. Where's me think? Above the 200 right there. Average price has crossed up, long-term trend. And we've got price retracing. It's gone red. So what I should be able to see is a dip in an uptrend. Now, that's what I've categorized these stocks. You've seen me rank and sort them before. So it's easy to do. Just sort them like a spreadsheet and it's done. But you can see that this group of stocks here, these should all be retracing in an uptrend. However, this one has gone blue. It's gone just like this. So what's happened? Again, I'm just explaining what's going on. So it's easy to see when you've got the tools that make it easy. Rally retracements below the moving averages. That's what we've just seen there. That's what we're expecting. But this has started to turn around and moving higher. Great. I'm only going to look at that stock today. Now, in fairness, I've already placed the trade. I did it on Tuesday, Wednesday. But I'm going to, if I need a trade, if I'm watching this 2 or 3 times a week, which I am, then that's what it looks like. That little traffic light system to say, hey, all those stocks that we're retracing in the context of the trend as we've just defined them, this one, row number 54, has turned from retracing into rallying. It's gone back to that profit, potentially a profitable rally. Now, again, I don't know what's going to happen, but all I know is that the conditions that I'm looking for, the quantifiable rules that we've just proven, that give me an edge like the casino, because I'm going to trade every event with impunity, has just been met. So I'm looking at the right stock at the right moment, at the right time, and this is what a Bible dip in an uptrend looks like. This is why it takes me an hour to explain and 2 minutes to do. Click, pick, trade. Trades, now in fairness, trades are already on, happened 2 or 3 days ago. Tuesday is when it happens. So I can move that stock to there. Halliburton. So now that is rallying. It's in my rally section. Take it off, just like a spreadsheet, now all organized. So these are still dipping in an uptrend. These are rallying in an uptrend. And I can start to quality control my production line. Again, I refer to it as a production line. You can see probably why it's a production line. Because it's like a production line. I'm going to move it from resting, retracing, as I like, dipping in an uptrend. Really interested in this stock. Going to move it to the next section and say this is rallying in uptrend. And I can start to quality control my production line. Am I in a trade? Yes. Great. I'm in a brand new trade on this one. Again, you can see why. Why is that, Phil? Glad you asked me that. Because the average prices are stacked. It's dipped in the context of a trend. Again, we've already identified this as a breakout, so I'm back to trading it like a trend rather than trade it like a range. We were range trading this as, for most of last year, as you know. But now it's trending. It's broken out by the dip in the context of a trend. This is an early stage trend. This is what we call a breakout. This is one of the 6 money-making patterns that we trade. It's now dipping in a trend, and I'm going to apply my trend trading rules. You know what a Bible dip and an uptrend look like. I spent an hour explaining it to you. Click, pick, trade. Quality control. Blue, blue, blue. Great. Trade is on. Is it on? Yes. Okay. If it's not on, I can start to ask myself why. Again, like WMB. WMB went blue, blue, blue. I should be in that trade. It was on my watch list. I was keeping an eye on it. There we go. I was keeping an eye on it, and price popped. I was away. I decided to wait. I was looking at it on that day there, and I thought to myself, you know, I'm just going to delay my trade choice because I was doing other things, and it cost me. So I'm not always going to get them, but I can quality control. So I've got to take satisfaction in knowing that the strategy was right, the process was right, and I just missed one on my production line. Again, I'm spending time away from the computer. I'm not looking at it all the time. I'm trying to emulate the historical performance, not map it exactly. And I'm okay with that. And I think you've got to be okay with that. I'm certainly come to terms with it. I've had great profitable trades on this. As you can see, I just closed a small profits on this, which I did. I think I made, I think it was a break-even trade as it ended up, just with how I entered this. So again, you're not going to get them all. Again, I'm just trying to throw a little bit of transparency in there. I'm human. I missed one. But nonetheless, I can quality control. And am I in those? Yes. Have I missed 1 out of the 5? I think I'm okay with that. I think I'm okay. I don't know if you'd be okay with that, but nonetheless, I am okay with that. But nonetheless, that is quality control. Now, these ones are still retracing in an uptrend. Now, with all the stuff that's going on, we'll circle the plane and land the boats. Roll the credits. We'll be landed. We'll be. I don't know. My insiders know what I'm on about. We're gonna land the plane in a moment. So these are the stocks that I'm interested in. These are the stocks that I should be trading. So these stocks are on a watch list. I don't need to look at them. I can do if I want, but I don't need to look at them is the point, because they're retracing in an uptrend. Now I'm interested in these stocks because they're dipping in the context of a trend. And I only need to potentially look at them when they go blue, blue, blue. Now I'm okay with mechanically doing this. Now what you might want to do is you might want to visually inspect them. And I encourage all my traders to do that, you know, visually inspect them. I'm expecting to see a trend. What do I actually see? Okay, I actually see a trend. Okay, good. It's dipping in a trend. We've already spoken about this. There was where it went above the moving averages. There was the Bible dip. I think I recorded some videos about this. So it's got me in the trade. Now, by simply using a stock option instead of stock, I can avoid potentially that monetary loss. I can already outperform the strategy by moving from stock to a stock option, because I'm going to use a stock option and use the full price of the premium that I buy as a built-in stop loss, built-in risk management. I'm going to buy at least 100 days. I think at the time I bought 130 something days of premium. I only need 30 of those days, but I've got more time than I actually need. And this is the reason why. I'm going to buy more time than I actually need. And I can outperform the algorithm just by changing the vehicle that I use. The vehicle moving from stock to a stock option. So I'm using a stock option as an alternative to stock, using the full price, the premium. So it doesn't matter how bad the stock dipped or how long it dipped for, as long as it's not more than 130 days, then that's fine. It's up to you. Anything some attention? What do you want to do? You can't trade with them today. Oh yeah. The cat's trying to do what Steve's dog did and join him trading and start using the desk. Anyway, squirrel. I'm having a day of it, aren't I? I'm really having a day of it. Completely distracted. Lost my train of thought. Oh yeah. So by using a stock option instead of stock, I avoid being stopped out. Now, it doesn't mean that I'm not going to have a monetary loss. No, it's just the way I'm phrasing it. It's not that I'm not going to have a monetary loss. I still have them, but I'm deferring that until expiration so that I have the ability to manage the trade more effectively between now and then. That's pretty cool. I don't know about you, but this also means that I don't have to worry about managing my exit if it's not working out. I've already done that on the entry. I only want to risk, say, $1,000. I'm only going to buy a certain number of option contracts, use the full price of the premium. Risk is managed, no stop loss required. You'll never be stocked out ever, ever, ever again. You will have losses, but I won't be stopped out. I'm not going to be stressing out whether, should I move my stop loss? Is it there? Should I do that? Should I have it tighter and do bigger position size? Should it be smaller and have blah, 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 you know, all those silly little questions. Not micromanaging my decisions. There's my risk. There's my stop loss. Buy one, strike out the money, and give yourself 130, 150 days to expiration. It's more than enough time for what we do. Again, the payout cycle is about 30 days, 30 to 45 days on average. That's the strategy reports will tell you all this information. My entry is there. As per the rules, I've avoided a loss already. Cool. Now, it might be that it still is a losing trade, a monetary loss. It might still be that way. I'll find out in 3 months. I'm okay with that. I am okay with that. Now, if it turns around and starts to behave the way that I prefer, like over here, there's exactly the same thing happened back in August. Went sideways, sideways, sideways. Took a new trade there. That one got closed out for a break-even trade. I was able to manage that more successfully, break-even. Did that there. So that trade was break-even. Small profit, actually. And took a new trade on there. So exactly the same thing happens. So early trade, for the moment, it looks like I've mistimed the trade. I don't know what's going to happen. But what I'm able to do is manage the trades effectively and go and do other things. I'm waiting to see if there's going to be a profit on this. There may be, there may not, but I'll find out in 3 months or however long you've got. But if you give yourself enough time for the trade to play out, then you've got enough time for it to play out or not, as the case may be. So just this is my pitch. I would encourage everyone to consider stock options for this reason, because then you're not stressing over the exits if your trade choices are, again, I'm not going to say wrong, but just mistimed, because we know they're not wrong. We know they're not wrong choices because we've got a strategy that has positive expectancy on a stock that behaves favorably. So we know it's not a wrong choice. So how can it be a bad trade? How can it be a bad trade choice? It's just a monetary loss. Maybe it was mistimed. Again, we'll only find out afterwards. But moving to a stock option means that I don't have to worry about the strategy when it hits a rough patch, because they're all going to have rough patches. That's what these down ticks in, I get to avoid all these down moves in the equity curve. That's what we're doing here. So that's a down tick in the equity curve because it's a monetary loss. It's being printed in the, so I get to avoid that. And what if there's 3 or 4 of them as price just meanders sideways? In, out, hokey cokey experience, and then it takes off. If you be stopped out once, twice, 3 times with stock, you might be pissed off. That certainly would piss me off. It has done in the past. But by moving to a stock option, that goes to 1, but only at expiration. So I get to avoid multiple stop outs if it's just jigging and poking initially before it starts to move. And if it's not, I might have the opportunity to manage that one trade more effectively. So I should be able to outperform the strategy. I should be able to see a similar equity curve, if not a better equity curve. And one of the other odds enhancers that we use is to move to a stock option. Give yourself plenty of time, use the full price of the premium. Don't worry about stop loss ever again and let the trade do what it's going to do, because we know that over a long period of time, over a large number of events, we should have a similar performance, just like the casinos have an edge in every game at the house. So be the casino is all I'm trying to say. That's a great place to land the plane. Let's land it. So edge is over a series of events and not over one event. If you're trying to trade one at a time, it's not going to work. If you're bouncing around from indicator to indicator, it might not work. If you're looking for the next thing, the next holy grail, it might not work for you. And it's because you're playing as a gambler at the casino instead of trying to emulate what the casino does. And that's have an edge. You get an edge with consistency. Right. Let's land the plane. Thank you. As always, thank you for your time and attention. Thank you also for staying the end. It's about Emily, Fitzroy, Glenn, Ian, Perry, Rajesh, Randall, you're not my friend, Rodrigo, Ruben, Steve, Vito, YB, and Zeke. Hello. If I don't mention names off the person, I'll just skip down the list. But thank you for your time and attention. We could all be doing other things. I certainly will be doing other things. I think Perry's off somewhere exotic, far off places. You've got your honey to-do list as well. What are you up to today? You doing anything interesting? And what was your big takeaway? Where's my takeaway? There we go. What is your big takeaway? Oh, thank you for asking. My pancake off was great. Thank you very much. Last Friday, I was making pancakes when we had a little pancake cook-off. Of course, I make the best pancakes. And then that was the practice event for Tuesday. Not necessarily a trading question, but nonetheless, how was Pancake Day last week? So what was your big takeaway, folks? Like gambling, you have to have a strategy. Absolutely, yeah. I like going to a casino. I think it's funny, actually. I was talking about this to my friend over coffee in my morning. Because we both like going to the occasional casino, but I think going in with a I'm going to have fun mindset, as opposed to going in to win at the casino. Because you go in to play the game, you're already at a disadvantage because you're not playing every event. So you happen to win, it's a bonus, is what I think. That said, there are some games that are more favorable than others. Again, I like roulette. It's statistically a bad game to play, but I'm going for fun, I'm going for a different reason. So yeah. Can't think of just one. Oh, thank you very much. I'll take that as a compliment, Glenn. Thank you very much. A few questions. Love having a system, plan the work the plan. Love it. It's true, very true. Right, I think that's it. Thank you for, again, being attentive. Thank you for attending. I'm certainly very grateful. Given all the bullshit that's going on in the world, I'm grateful for my location in the world. There's a lot of people that are having a very difficult time at the moment. And as I said on the podcast this week, I'm kind of embarrassed for the human race when we've got to go to war. Well, do we have to? It's not a necessity, but yeah, kind of embarrassed for the human race at the moment. But it's an unfortunate thing that's happened. So I'm very grateful of where I live. I'm very grateful for that. I like to openly practice this. I find it very beneficial. And I would encourage each and every one of you to include just that being thankful and grateful in your lives, especially because there's some people that are having a difficult time at the moment. If you're in a place where you can do something about it, then, you know, help where you can is all I'm going to say. So we, certainly I like to do this in my private group as well, but just leave you with this food for thoughts. From a business point of view, we've spoken about stocks. We've spoken about strategy today, the business of trading. I would encourage you to think about what curiosity that you're going to explore today or this weekend or in the next week. And what I mean by that is, what are you going to do to feed the minds? You know, what are you going, and it doesn't have to be like research or training, but you know, what are you going to be curious about? What are you going to expand your horizons with? And the thing that I focus a lot on is what fun thing you're going to do either today, over the weekends, over this week. We had a very interesting discussion last night about Twixes and how best to eat them. It was a silly little thing and it whiled away an hour in our private trader group, but it was a fun thing for everyone. It was a silly, it doesn't have to be a big thing. It could be a little thing. It was just something that we were all looking forward to. I know the variety of Twixes was amazing. And it was a silly, it was I'm laughing at it thinking about it, but it was super fun. It was super simple. And probably everyone is now thinking about eating a Twix and all the wonderful, weird ways that we can do it. But nonetheless, it was fun is the point. So what fun thing are you going to do, either with yourself or with a loved one or your family? But yeah, so just keep that in mind. So business, it's not always about business. Feed the mind, feed the body and the soul. I like humor, laughing. I like living. So that's what I would encourage each and every one of you to do. So yeah, go and do it. If you would like to speed up, if you'd like to work a little bit more closely with me, I do have a private group. So if you want to talk more about it, it's there. You can go to my website, AntiVestor.com, and just follow the instructions. So if you'd like to work more closely with me, I do have some vacancies at the moment, and you're free to explore that if you choose to. There's no pressure. I appreciate that what I do is not right for everyone. If it is right for you and you want to talk, just follow the instructions and we can talk. That said, have a great weekend. Do I need to change the order of these slides, don't I? Have a great weekend. Where's my goodbye slide? Oh, bollocks to it. Can't find it. So nonetheless, have a great weekend. And whatever you're up to, make sure that you enjoy it with someone. Enjoy doing something new. Feed the mind, feed the body, feed the soul, and just go and have fun. Otherwise, what's the point of doing this trading thing if we can't enjoy the fruits of our labor? So have a great weekend, everyone. If you need me, I will be around. I'll be near the desk for the next hour. I've got to catch up on some support questions, so they'll be on their way in a moment. Just for some of the members, actually, I do have an algo update, so I'll be posting that in the members area. So one of the bugs that we've been talking about has been fixed, and that that finds other questions, that finds other bugs. So nonetheless, we're working on it. So we've got a little snafu on the targeting. So it's not the strategy, as we keep saying, the strategy engine works just fine. It's just having some of those lines help and assist you. So it's the